Welcome back. You're watching Traders Corner. I'm Bronwyn Seaborn, and with me at the desk, as usual, is Garth McKenzie, founder and editor of Traders Corner. Garth, thanks so much for your time today.
Thanks. Hi, Bronwyn.
So we've had a brutal October and a rather rough November. As we head into December, what is the S&P 500 and the Nasdaq 100 telling you? Have we found a bottom?
I'm not sure whether we found a bottom, but it's certainly trying to find a bottom, if we can put it that way, for the near term anyway. The chart of the S&P 500 is up on the screen now, and this is a daily chart looking back for the year to date. We will refer back to the S&P 500 again a little bit later in the show when we look at a couple of the bigger global indices. But in terms of where we are right now, the market broke below this upward trend, which had been intact for quite some time. That trend line actually goes back over the last 3 years. And it was broken on the move below 2,800 in October. And you can see the market has rebounded and moved back up to retest the underside of that upward trend. That area acts as resistance now. As you can see, around 2,800, there was quite a lot of resistance there into that rally. And it's come back down. Now, look, there's a big zone of lateral support down here at around about 2,600. And we haven't quite gone down to retest that low in this leg to the downside now. And I'm still betwixt and between trying to decide whether it's actually going to go down there or not. I suspect it could possibly still have one last shakeout where it maybe goes and tests that 2,600 area, maybe flushes even a little bit below that area. But I think if we then get a move into that area to really shake the tree, as it were, and put in a nice reversal from there, then I think what you could find is that you then get a rally into the end of the year if we see that shakeout into that area. So I don't know. I'm a little bit loath to be going long on this market right now, this kind of area. If it did trade down into that 2,600 area, I would be more comfortable putting on a long trade from there, I think, looking for a bounce.
Okay, so then on the Nasdaq 100?
It looks quite similar. So you've also got this, what was a nicely upward trending market up until October has had a big smack in the last 2 months or so. And you can see this market peaked at 7,700. It's traded down to 6,500. That's a very, very meaningful pullback in a fairly short space of time. Now here you've got a big lateral zone of support at around about 6,300 to 6,400. And I think, again, if we do have a flush down into that area and then a nice solid reversal up from there, then potentially we could actually line up a bit of a bounce into the end of the year. What's quite interesting to note just on this chart, and it was also evident on the S&P 500, is that if you look at the 50-day moving average and your 200-day moving average, the 50-day is the blue line there, and then the 200-day moving is the red line. Now you can see those two moving averages are actually about to cross over. Now typically when you get the 50-day moving average crossing down below the 200-day moving average, we call that a death cross. And obviously the name says it all.
Sounds rather ominous.
Indeed. But funnily enough, and a lot of technicians and technical analysis books and whatever will tell you that is a sell signal. And perhaps on a very medium-term basis it is. But in my experience, actually when that happens, inevitably you actually find the market rallies quite a bit at that point in time. So I would be very loath to actually take it as a sell signal at that exact point in time. My experience has actually shown quite the opposite, is that often when you do get those crossing over, you can probably buy for the short term, but medium term it's certainly telling you that the momentum is rolling over.
So we're not counting out a Santa Claus rally just yet. So then let's come back home, because we've bounced off that 44,500 point mark. Are we hoping for a recovery? Are we also going to see a bit of a Santa Claus rally here?
Well, yeah, we are hoping for that, I guess. Here's our top 40 futures chart at the moment. And as you mentioned, we traded down to 44,500. We flagged that on last week's show as a support level to watch out for. And we said that if the market holds that level and manages to reverse up and bounce off there, then potentially we put in some kind of a double bottom and maybe we see a bit of a rally into the end of the year. Now, as things stand at the moment, it certainly appears as if the market is making an effort to try and build some sort of a bottom here. We've managed to break that steep downtrend. That's that blue downtrend that I've introduced onto the chart there. We have managed to break above that level now. The market is still a little bit lethargic. I mean, when I checked right now before we recorded the show, I see that it's a little bit negative on the day now after being positive earlier in the session. So it's certainly not as if the buyers are coming out in force to push this market up just yet. But I think if we can stabilize around this sort of area, and maybe if we can start to push out above 46,000, that's now quite a meaningful resistance area. then possibly we have the makings of a bit of a rally into December. There is still a gap in the charts a little bit higher up there where I'm pointing out now, and that comes in at around about 47,800. So, in the event that we do get a rally in December, it's possible that that area could be targeted. But I think for the most part, this is not a bullish chart setup. It's broken below massive support there at 49,000, and it seems for now we are going to probably be choppy below that 49,000 resistance area for the foreseeable future.
Okay, so then we were keeping an eye on Mr. Price for a possible trade last week. You were saying, they were kind of leading the pack as far as you were seeing it, and they produced a great set of results in the past week as well. So did we enter that trade? How did that all pan out for us?
Yeah, so unfortunately we didn't actually get in. It is very frustrating. I did all the analysis last week on the show. I showed why I like it. I showed the level that we would be looking to potentially buy the stock. So what I showed from a technical perspective was that this upward trend that had been in place since September was still very much intact, and that each time the price had flushed down below the 50-day moving average, it seemed as if there was a bit of buying that would come in at those lower levels and then take the price higher. And I identified the support area at about 220 to 225. So I actually put a bid in at 220.250 to start nibbling on some. And unfortunately, it actually didn't trade below that 225 level. It just didn't get below there. And then we had the good numbers that came out, and the price rallied. And essentially, I missed that trading opportunity, which is quite frustrating because everything was looking right. My analysis was right. My thinking generally was right. But I wasn't on board to take advantage of the move to the upside. And you can see it's actually had a nice trot. It's gone up from 225 all the way up to 255 at yesterday's closing price. So, more than a 10% rally in the share price in the week since we sat here last. And it's quite a pity not to have participated in that. It would have been nice to chalk up another winner into the end of the year, but it is what it is.
Garth, I know we often speak about, the levels that we're targeting, and you're quite diligent about sticking to those. But in the case of Mr. Price, when you are watching for it to reach that bottom, but you start seeing it turn up, aren't you tempted to get in? Because you might not make as much as you were hoping to make, but you've got to think at that point, I'm at least going to make something.
Well, that's right. The trouble is it comes back to a question of risk to reward ratio. We always strive on the show to try and identify trades that give us a risk to reward ratio of at least 2 to 1 or 3 to 1. In other words, whatever you're risking, you potentially stand to make 2 times more than that amount, or potentially, ideally, 3 times more than that amount. That's a good setup for me. And the trouble when you start chasing a trade is that it skews your risk to reward ratio. So if I had started to chase this trade and then have a stop loss quite far away, suddenly you don't get such a good risk to reward ratio on that anymore. So it is frustrating. I can sit now in hindsight and look at that and say, gee, I wish we had just bought it at that 225 area where the low was, and not been greedy for that extra, 2 rand below. But it's easy in hindsight. It happens in trading. And I kind of say to myself, this is probably something that happens, it's more the exception than the rule. It doesn't happen all the time. So it's not a problem. We move on. The nice thing about the market is that there are always other opportunities that keep coming along. So yes, it's frustrating to miss out on an opportunity, particularly when you've spotted it and then still didn't act on it. But it's not the end of the world. There will be other opportunities, and we just move on and find the next trade.
Because it could have just as easily gone the other way, right?
Yeah, exactly. In which case then we would have been kicking ourselves for chasing it, only to then see that it gets stopped out.
Absolutely. Okay, so we're not going to enter into any new trades for the years as the portfolio kind of closes out, at the end of November. So let's maybe throw forward a little bit. You've got 3 charts of major equity indices that you're going to look at, and maybe give us insight into what we can expect from next year, right?
Yes, I just want to look at some weekly charts of the major global indices here, just to try and sort of set the scene, because this year has been an interesting year for the markets. It's been more volatile than what we had seen in 2017 and 2016. Yeah. And that volatility in and of itself is probably a bit of a warning sign of a certain level of discomfort in the markets, a bit of uncertainty. So let's just have a look from a technical perspective. So I'm going to start in the west and then sort of move eastwards. Okay. And we'll start with a look at the S&P 500. This is a weekly chart, and as I said, it goes back to 2016, which is 3 years ago. The dominant feature on this chart for me is the fact that it's broken below the steep upward trend, which has been intact for the last 3 years. And we've got that lateral support zone at 2600, which I've already alluded to earlier. Now, for me, that technical damage is quite meaningful. The fact that we've broken that upward trend is very meaningful, and it suggests to me that there's a fairly strong chance now that this bull market that has been intact since 2009 actually could have peaked out, and that next year might start to see things rolling over a little bit more. So my expectation is that for now we probably hold this 2600 support area, and we maybe begin to form maybe the right shoulder of a Head and Shoulders or something here. I'd be very surprised if we go and retest or even exceed those highs that we saw in September this year. And then I wouldn't be surprised at all if at some stage next year we actually start to see this market breaking down below 2600, and that would open lower targets. I just think fundamentally there's a lot of risks on the horizon. We talked about these many times: trade wars, rising interest rates, the end of quantitative easing and the start of quantitative tightening, high levels of indebtedness, et cetera, et cetera. And there are medium-term warning signs or risks of a US recession potentially on the horizon, late 2019, maybe out into 2020. And your markets, your equity markets, do tend to start to discount that and price it in ahead of the time. So I think we've got to be careful next year. I think it's likely to dish up more volatility, and we're going to need to be on our toes to take advantage of that.
Yeah.
So that's the S&P 500. And then if we head across to the European markets, the DAX obviously is the big market in Germany. And this market really doesn't look good, actually. And I don't think a lot of people have spoken about it really, not that I've noticed a lot. But I mean, there's a huge Head and Shoulder topping pattern on the DAX index here. And you can see the break below the 11,800 level was a break below the neckline of that pattern, which actually validates it. And from a technical analysis perspective, that pattern actually projects a move all the way down to 10,000 on the DAX. So I won't be at all surprised if we see 10,000 next year at some stage on the DAX. And what we'll be looking at from a trading perspective, I think, is any rally back towards this 11,800 neckline. I'd possibly look to put shorts in at that sort of area. We'll watch it as things play out, but that for me is still a rather ugly looking chart, and it looks to me like the bias is still going to continue to be to the downside into next year. Then the Stocks Europe 600 is also a very large European index, and it incorporates 600 stocks from right across the whole European geography, not specific to any one country or any specific sector. It's a whole array of different stocks. And again, here you see a Head and Shoulders pattern, very much like what we saw on the DAX, and it's broken to the lower end of that neckline. So again, here it points to a technical target of about 330, which is around about 10% below the current trading level. So again, I think this is a market that you probably look to short on rallies into next year. And then looking further east, now we're looking at the Nikkei. This is the Japanese market. This one was actually looking pretty solid up until just a month or two back. It rallied out through some overhead resistance at 23,000, rallied on, made a brief new high in the end of September, and then it very, very quickly fell away. And it's now also done what that S&P 500 chart has done. It's broken below the upward trend of the last 3 years, and it seems to be establishing itself below that uptrend. And that's, from a technical perspective, that's damaging, and it signals caution to me. And I think there's a fairly good chance we're going to see this market come down to where that dotted line is at about 20,500. So that's still 1,200 points below where that market is currently trading right at the moment. And then the last one that we're going to look at is the Hang Seng. So this is the Hong Kong market. And this one really actually has had a very, very tough year. And if you think about Tencent, Naspers, and then we know what's happened to those stocks, how they've been thrashed this year. But then you've also got the likes of Alibaba and Baidu. And these internet stocks that make up a heavy weighting in the Hang Seng index have all really had a very difficult 2018. And what it's actually resulted in is the Hang Seng peaked in January of this year at 33,000, and it's traded all the way down to almost 24,000. So that is it's lost a quarter of its value during the course of this year. Very, very bearish setup. It has managed to bounce off some support here at 24,500, which is encouraging for now. But overall, to me, that chart's still not looking great. And I think along with the rest of those global index charts that I've looked at for this year, I think one needs to be cautious next year, and it probably still lends itself to shorting rallies into next year. So
we're going to get into all of that in coming episodes, and we'll get into the portfolio as well, because we've just run out of time. So Garth, let's leave it there for today. Garth McKenzie is founder and editor of Traders Corner.